Hello, everyone. We're here to discuss a little bit about the financial analysis and global cash flow. This is one of the subjects in my almost 20 years of banking that I find one of the most needed opportunities to discuss with small business. I've come across a lot of small business owners and different levels of experience, different levels of know-how when it comes to their financials. And when I was asked this opportunity to speak on this, what type of documentation to talk about, financial statements and analysis and cash flow is one of the biggest missed opportunities of business owners, but is also one of the most important to understand where you're at financially with your company as the days go in and out. Unfortunately, a lot of companies that don't pay a lot of attention to this. And it's very, very crucial to understand where your company is and where you stand, and not just to know what kind of balances are in the account. And if you have enough balance in the account, then life is good. And we see the projects coming in, that everything's going to be fine. So this is going to be a really deep dive into understanding financials, understanding income statements and profit and loss. So really look forward to really diving deep into this. And so let's go ahead and get started. So 5 C's of credit is obviously character. One of the things that we look at as far as underwriters go, we look at opportunity of who are we as, who's our borrower, and who are we working with. So character is a very important piece of it. So we look at the credit report, obviously. A lot of banks only look on the personal side of credit. There are times where some banks will look at the business credit, but primarily it is who are we working with? Who is the individual that we're going to be financing through and working with? And so credit reports are very crucial. There's a lot that we can get into with credit reports and understanding credit and what the impacts are with credit. With credit limits with credit cards, a lot of people try to utilize a credit card as their avenue of funding, which is not a good source. I mean, you're typically on average, a lot of personal credit cards are up to 25% in interest. It will suck your cash flow, which we'll get into in a little bit. So credit reports is very important. You keep a good, clean credit report. You can go to annualcreditreport.com and look at that. Just make sure you type in that actual field into the address field. I don't try to Google that because unfortunately all kinds of opportunities come up to trying to sell you things like that. It is completely free. You can have an annual credit report and understand and see what's on there so you can fix anything that's there. So capital, financial structure of business through liquidity, solvency, and debt structure. And we'll get into deep dive into this on your balance sheet. Capacity, your global cash flow. So after all is said and done, after your monies are out, all your expenses all your income has come in, all your expenses are out. What is at the end? What's left over? And what kind of capacity does the company have to be able to fulfill the debt service that's out there? Your monthly bills to pay your liabilities out there. So capacity, collateral. Obviously, there's some types of loans that are out there. There's different types of collateral. So you have your typical real estate. You have accounts receivable, and we'll get really into depth of that and kind of give a perspective of where the bank sees as opportunity of lending with accounts receivable, and then valuations and things like that. What's the value of the company in itself, and the cash flow piece that we're going to get into is really going to help you with that, and be able to take your own personal company and look at to see how healthy is your company and what parameters does the bank actually look at and to facilitate the strength of who you are as a business. And so really look forward to this. Will be a great exercise to be able to do for your own company as we go into and you pull your own financials, which I do encourage. I do encourage you to go ahead and pull this while we're going through this this training or course, whatever you want to call it, opportunity. So it's going to be a really good exercise for you to kind of see the health beat of your company. And then conditions, the guidelines, conditions of loan approval, the purpose of the funds. What's the structure? Are you properly trying to get a line of credit for the proper use of a line of credit? or are you looking for a term loan for capital injection into the company for the right purposes? This is one of the misnomers. Banks will typically will help you with this if you have a decent, good banker, good solid banker to work with you. But it is important for you to understand what is the right type of credit for the right purposes. And it'll help with that cash flow not to over leverage yourself in situations. All right, so that's the 5 C's there. Basic components of financial statement. So you have income statement, also known as a profit and loss, company's income, expenses, and you're at the end, what's the profit? What's left over? Statement is over a period of time. So your income statements are typically, you can do a monthly, you can do quarterly, you can do yearly. You can do a comparison versus 2019 over 2020, dealing with the situations that we're dealing with in the economic times that we're in. And we're going to get into this a little bit more in a little bit, but it's very crucial for you to do a comparison with your income statement from 2019, likewise to your current year-to-dates. It's going to be very eye-opening for you to see where your company is at, or see some shortfalls as far as expenses, where you can cut some expenses and revitalize the company. This is, I'll take a brief moment here and discuss this. This is an absolute crucial time for your small business, for you to take a deep dive in to see what opportunities you have to correct, fix, or minimize expenses. I'm sure you all have already done this because of what we've gone through. But now it's time, okay, you minimize a lot of expenses. Some may have had to, let go of some people, hopefully not. Hopefully you've been able to maintain that. But what is it in the company right now that you could go in and revamp, new creative ideas to make your company, because everyone is having to revamp things right now. And you're seeing that significantly. We're seeing that a lot right now on our side with our clients. So statement is so your profit and loss is over a period of time. Your balance sheet is a statement of financial position. Where it's a snapshot. At this moment, what does your company look like? Reports and companies. So it's your assets, your liabilities, and what's in between that is your equity. So remember that the balance sheet is a point of time. Quality of financial statements available. So these are the different types of financials of who is doing it and what level it stands at. So your company prepared is your typical bookkeeper that's either works at your office or somebody that you've hired to maintain this. Your CPA compiled, and the further down the list we get, the bank sees as a more higher level of quality when it comes to your financials. So CPA compiled is just when they, a lot of times either take what your bookkeeper has put in and they'll compile it, or they'll actually do it themselves. So CPA prepared tax returns. You notice that this is not on the very bottom of the list, being that most important, because we do take a high record for CPA reviewed financials, and then CPA audited. Qualified and unqualified audited financials is the most highest level of financials that we regard when it comes to looking at and underwriting. So your balance sheet, obviously you got your assets. Assets are obviously your blessing, the things that are coming in, and your ability to the strength of the company to be able to take over and to be able to maintain and fulfill. Your liabilities is going to be obviously is one that everyone has to be very cautious of and be careful of. Lending is important for, especially in a major growth spells, which I'm seeing some companies are in that position and some aren't. So liabilities is as a necessity at times, but be very cautious of making sure that you're not over leveraged in your lending facilities. And then obviously you have your equity that's there, but it's very, very important to keep this at a balanced level, hence balance sheet. Main components of the balance sheet. So as we just spoke about, assets, liabilities, and equity. This is what the assets are going to be what the company owns, liabilities what they owe, And then the company's net worth. What's the equity of the company, sometimes also known as retained earnings. You got to own this. These financials here are so crucial, and making sure that you own this aspect of your company. A lot of people just do the tax returns. They look at the tax returns. Yep, see the bottom line. It's positive, negative. Oh, this is greater than before last year, or not greater than last year. Okay, I need to do this and do that. This financials and your main component of your company is very crucial to understand where you're at. And I can't stress that enough when we go through this. Very important to understand where your company stands. Accounting equation, the balance sheet. So your balance sheet, again, is the snapshot. Where is your company at this current moment, or any current moment that you pull? You can pull December 31st, 2019, and you can pull today's. Where is it? It's a snapshot. It's not a period of time. And your balance sheet reflects the financial condition of the business entity. And so obviously it's your liabilities plus equity equals your assets. So your assets are going to equal whatever your liabilities plus your equity is. This will help the company. This is what we look at on the bank side of what is the strength of the company to be able to take care of itself if something were to happen. This is one thing that we look at very heavily right now when it comes to lending, and looking at the strength of the company and where are your assets and your liabilities and what this is. And we're going to go through some calculations in a little bit that it's going to be very important for you to do the exercise on to understand where your company is when it comes to the strength. So what are assets? What are the categories that fall underneath on the balance sheet that you look at? So obviously it's cash, what you have in the bank. Temporary investments that you've made to constitute either new product or new invention, new opportunity. Accounts receivable. Business that you have completed that you have not yet received and receive the funds for. We're going to dig deep into accounts receivable and the calculations that the bank uses for the strength of what we are able to lend against when it comes to accounts receivable. Very good exercise for you to do for your own business as well. Merchandise inventory. This is obviously product inventory as well, not necessarily only merchandise. If you're a manufacturer, obviously you're purchasing products and parts to make something. So it's really constitutes anything that's in your inventory. So office supplies, your buildings, real estate, and property and equipment, patents, things that you have been able to patent that is proprietary to you and which you've been able to accomplish and create, and then goodwill. Liabilities, accounts payable, obviously rent payable, salaries payable, estimated warranty liability, dividends payable out to your employees or owners, long-term liabilities, and discount on bonds payable and tax payable. Equity, obviously it's withdrawals out of the company, common shares, preferred shares, retained earnings, and dividends. So let's look into understanding the assets. Let's dig a little bit deeper into this. Assets give the reader a snapshot of the availability of cash and liquidity, pay its debts. Are you trying to do a project that you don't have the cash to be able to accomplish? You need that reserve for the what ifs happen. What if something does occur and you don't have the backup to sustain that? And then you're trying to scramble real quick to trying to find some capital, trying to find something very quickly to be able to recover. Not a good position for you to be in, definitely a position that banks and underwriters don't want to see in. And the assets are going to be a huge component that we look at to understand where are you, where does the company sit. And the financials and the balance sheet is going to be a catapult to where we are and where you are as a small business. And unfortunately, the numbers don't lie. So when we see that, we see the numbers, they're going to tell a story to us so we can see what's going on. So current assets and non-current assets or fixed assets. Your non-current is typically your equipment, your vehicles, real estate, and things of such. So current assets, assets that are expected to convert to cash or used in business within 12 months. Listed in an order of liquidity. Example is cash, securities that are out there that you're able to cash in. That's not retirement money. It's non-IRA or non your traditional Roth opportunities. It's marketable securities that you can go and take out without huge penalties. Accounts receivables, inventories, obviously work in process. So things that are in the middle, it's not quite hit the accounts receivables yet. Work in process is going to be items that you're just currently working on. A lot of manufacturers have this called WIP, and this is something where we look at and see what's going to be coming in the horizon of opportunity, and then finished goods, product ready for sale. All right. So accounts receivable, a detailed accounts receivable aging report. It's important for aging. Understanding is it 30, 60, or 90 days, or even past 90 days, owned to the company or for products or services rendered. Most receivables should be paid within 30 to 90 days. Receivables paid after 90 days could mean the company has customers that are not reliable. Anything past 90 days is getting to the point of collections time, and that's the way you need to see it. Some are known, like government is known for paying late, but anything past 90 days, you really need to start honing in on this and understanding what's going on here. Why is this happening, especially in the time that we're in economic times and situations, because you don't know what's going on with the other company that you're providing a product or service to and what state they're in financially. So what we look at when we do lending on accounts receivable, we look at anything below 90 days. So, and then we'll take the 90 days and do 80% of that number as far as the lendability, do that. So again, anything past 90 days, we will subtract from accounts receivable. We'll take the number from up to 90 days, and we will do a line of credit up to the 80% number. So definitely a factor that you can take a look at. Look at your snapshot. What does your balance sheet look at today? What is your accounts receivable? Take the aging report, and then you take that aging report, subtract out anything past 90 days, and then 80% of that number is we will typically look at as far as doing lines of credit for as well. There are times, and a good amount of times, we'll also take your inventory report and do up to 50% of that. And each company is different, so it is based on what type of industry that you are in that we look at this number and do lending in respect to, as far as to come up with what we call a right size number for what your credit limit would be for your line of credit. So all right, so accounts receivable can be a source of collateral for a lender. We're talking about this. And it's oftentimes the case for a business line of credit opportunity. Non-current fixed assets. Long-term assets are assets that usually convert into cash. In other words, they're expected to take longer than 12 months to convert into cash. Real estate, equipment, things of that nature, intangible, intellectual property, assets that have a value but do not have a physical form. What is your goodwill of the company? What is sellability or the value? And your patents and copyrights. Okay, good. So asset values. Value of the asset is generally based on original value or cost inception. Value is then depreciated. So you have, we can get into this a little bit in depreciation. When we look at, there's two different types of depreciation on tax returns. You have your regular depreciation and you have your amortization. And just not to get too deep into this, but depreciation is typically what you look at like a real estate. It's taking the value and over a period of time, it is depreciated, and you can utilize that as a tax write-off or expense on your company to help minimize your tax liability. I am not a CPA, so talk to your CPA when it comes to these kind of things, but just so you have a basic understanding of this. And amortization is your snapshot of a period of time as well when it comes to amortizing out your number for a specific time and like that. So again, I'm not a CPA, but those are two aspects that you can look at for depreciation. So depreciation is a form of accounting and taxation purposes and impacts the balance sheet. Off-balance sheet equity can occur when you have an appreciating asset. Real estate, given that the value of that asset generally does not grow on the balance sheet. Typically, once you have the value set on that balance sheet, it typically stays the same unless you want to reevaluate the value through appraisal. Liabilities are an important part of the company's financials. Liabilities are essential monies owed or debts of varying types. Again, like we've said before, liabilities are a great avenue for a company to be able to help grow and sustain opportunity when you have a particular product like lines of credit and things like that for short term. And then obviously things for real estate when you're looking to grow and get a bigger facility versus leasing. You can eventually own the property that you're on or have and not have to worry about landlords and things of that nature. So a company's liability, the company's ability to properly leverage its assets is a great way to finance additional growth as well as purchase additional assets and inventory. Additional assets and inventory afford the opportunity to increase the amount of products to sell, therefore improving revenue opportunity. Lenders like United play an important role in financing a company's growth and profitability. One thing I'll say is that when we look at, be cautious if there's a bank that's out there that you're working with and they have some question as far as approvability of what you're doing. Be careful of trying just to go sporadically out there and try to go get lending. It should put a check into you, understanding, okay, why is it that they're not approving this? What is it that's missing here? Or is my company not as strong as I thought they were when it comes to lending? Not all banks are, every banks have different parameters. So not saying that this is always the case, but it should put a check in question that you need to kind of dig deep into your balance sheet and your income statements and your tax returns to understand, why is my company having a struggle of approving for lending? There's two main categories. So you have your short term, which is like your business lines of credit. Business lines of credit or structure are very good to have when you have a product in the horizon and you don't have the money to be able to pay for the materials for that particular product to either make or service to your client. And the line of credit will help advance that money for materials. You make the product, things go well, you service that product or that service or product to your small business. And then once you receive the payment, you pay back the line of credit. You don't use a line of credit as a crutch to maintain and keep a balance of. You want that always to revolve back. You want to pay it down, utilize it, pay it down, utilize it. It's very important because if you don't, then those assets that you receive from your accounts receivable and you don't use that to pay down your line of credit, that money's going to end up getting used somewhere else. And then what happens when you have your next big project? Because word gets around, right? A lot of companies get business by referrals. And what happens when you get that new business and you don't have the capital to be able to pay for that product or service that you're providing for that new opportunity, and you've already utilized that line of credit, there's no more balance left on that, or that balance is very high, what are you going to do? You're going to immediately come to the bank and say, hey, can you increase this? And you're going to get yourself into a bind, where it over leverages your company. So it's very important to be disciplined with lines of credit. Lines of credit can be a major blessing, but a line of credit can be a major curse also as well. It can be very, very crucial to make sure that you're very disciplined with lines of credit. Long-term debts and liabilities are primarily equipment or your real estate avenues. So we kind of dug into this a little bit. We'll talk a little bit more. Accounts payable, trade debt to vendors, suppliers generally due within 30 days. Be careful not to get into the binds. Your reputation is very important here with accounts payable. You got to pay your vendors and your suppliers. You shut down your vendors and suppliers, you're going to have to start scrambling and trying to figure out how to find new vendors. So it's very important that accounts payable as always stays current. Lines of credit, notes payable, we talked about this. Short-term notes and lines that are expected to be paid within 12 months and may revolve within that period, a year period. Again, think of it as a line of credit as a roller coaster, up and down, pay it back, utilize it, pay it back, utilize it. As you receive funds from that particular project that you used it for. Lines of credit are not used for purchasing equipment and things of that nature. That is what your short-term position of long-term debts is utilized for. The company has a $100,000 mortgage or short-term portion of that long-term debt includes only principal to be paid within the next 12 months. This is again, short-term is within 12 months. Your short-term position typically wants to be something within a 12-month period. And your long-term debts are going to be things that are extended out a little further. So short-term loans, as an example, for equipment, will be past 12 months typically. So that's considered a long-term debt. Accruals include items such as deferred revenues and custom deposits. These are monies collected by a company over the however, the company has yet performed services to earn the income. So you're accounting for it on your balance sheet, but you have not quite yet received those funds at that moment. Accounts payable aging report. So very much like you have with your accounts receivable aging report, where we look at your up to 90 days. We do 80% of lending to that. What we will typically, and these are loans for larger amounts. So typically, like for instance with BankUnited, anything that's under $250,000, we're not going to do this in-depth deep dive into these. But this, for the purpose of this course, is really to help you understand where your company is. So lending up underneath $250,000, we don't go into all this. So just so you know, and most banks, a lot of banks don't. They'll lend without very, very, very minimal financials in our case as well. But this, obviously, for the course and for the purpose of this, it's important for us to dig into this so you understand it. So accounts payable aging report. Aging simply just means it breaks down your typically 30, 60, 90 days, and then the 90, your 90 plus. Or sometimes you'll see 120 days, hopefully not be the case in your small business. But so very much like accounts receivable, like I said, it's aging. And this helps a snapshot of where your company is. You'll see down the bottom is 15, 30, and 45. Typically, it's 30, 60, 90 in most cases that you see. But what do you require your client to pay? Do you require them to pay in 15 days? Do you require them to pay in 30 to 45 days? What have you set as a staple for your company, for your vendors? It's important to make sure that you do that. But accounts payable, you got to set that up with your vendors and expectation out there. How current is the company within payment to creditors? Company timing of repayment is equal, important to its ability to pay its creditors, such as essentially BankUnited if you're lending with us. This helps identify potential red flags on the character of the obligors. So is the borrower having an opportunity of struggle with paying their accounts payable? Extend payables may be an issue or may be okay. Ask if these are extended repayment terms with the vendors before raising a flag. Long-term liabilities amounts of payments generally owed beyond 12 months generally require collateral, so fixed assets or real estate. Offers a company the chance to purchase long-term assets which are expected to generate revenue for many years. Machinery, equipment, things of that nature, computers, and things that are necessary to fulfill what you're needing to accomplish for your company to make the product or service that you provide. So the risk of long-term debt is when the company becomes over-leveraged and finds that operational cash flow is unable to cover the debt service of a long-term loan. Very, very important that you don't, let me say this, very, very important that you protect your cash flow. Your cash flow, if it's not protected, it could create a very, very healthy company to fail. And because of the cash flow, the over leveraging the company, it is very important that you do not do. Basic types of long-term liabilities and mortgages and financial institution debt. These are long-term mortgages, term loans provided by financial institutions, shareholder loans, loans from a shareholder. Rather than contribute cash as equity to the company, shareholders sometimes loan money to their company. It's important to understand any repayment terms associated with this debt. It should be noted that a bank may require one or both of the following. So this is getting a little more in depth here, but subordination agreement. So and then standstill agreement. So they're willing to subordinate the debt, still make payments on that debt, but will be willing to subordinate. In other words, go behind the bank. So the bank be in first position. If we had to collect on collateral, we would have first right to the collateral. Standstill agreement is where there is no principal and there's no interest payments being made until the loan is being satisfied. So if it's a 5-year term loan and with a bank, standstill agreement, it's going to be a situation where there's no payments whatsoever, principal or interest paid over that period of time. What is equity? In accounting, equity or owner's equity is the difference between the value of assets and the value of liabilities of something owed. It is governed by the following equation. So we talked about this a little bit and just kind of reversing a little. So equity equals assets minus liabilities. What is left over? After you have your equipment is worth $100,000 and you owe $80,000 on that piece of equipment, your equity is 20%. It's $20,000. All new companies need some level of financing to build assets or to grow its business. Financing can be a source from a bank or lender, or it can come from capital contributions from shareholders. This funding provided by the company by its owners, shareholders, is considered equity. Common equity items and retained earnings. Common stock, form of corporate equity ownership and voting rights. Additional paid in capital, aggregate amount of capital contributed by the shareholders. Retained earnings, essentially a company's profits that are retained in the company to invest in future growth. But let me stop right here real quick and just mention this. This is something that banks do look at and pay attention to. It's very important that you do as well. What we see in different companies and small business owners, you see money is left over in the profit, and some small business owners will take that money and just transfer it into the personal. So, oh, this is money we made this year. Well, I'll just take it out and give it to myself personally. And this is very dangerous to do, especially when a company's in growth, but especially really at any point in time, very beginning or very major growth periods of time. It's important that you make money from your small business, but don't starve it. Don't cut it between the legs, and so it doesn't have the legs to be able to run on. You got to keep the capital inside the company to be able to help it grow, help it strive, or revive itself into growth. So if you take the money out and put it into your personal and use that for personal purposes, obviously you need to get paid. You need to make a salary and things of that nature, but don't starve the company. Don't cut the legs out from underneath it to be able to maintain itself. It'll create a healthy company in the future. This is something that we do look at and keep a close eye on. Is sometimes we see this as a negative number. And companies in the very beginning are going to be negative a lot of times. It takes sometimes a year or two for a company to be able to get up on its feet and start seeing that growth where it needs to be. But if you're a company 5-10 years in, you definitely need to be having a positive retained earnings, but definitely continue to keep a healthy number there to keep money into the company, help its growth. The way we see it is how much do you cherish your company? And the higher the retained earnings that we see, the more we understand that you are invested into your company and you appreciate your company because you want it to grow versus taking all the money out and using it for other purposes. Positive versus negative equity. Equity is the difference between a total assets and total liability. This difference is also known as net assets. Positive equity implies that the sum of a company's assets is greater than the sum of liabilities. So positive equity, you have your assets are higher than your what you owe. So money in is higher than what you're paying out as far as lending goes. Negative equity implies that the sum of a company's asset is less than the sum of the liabilities on the balance sheet. This indicates the company is essentially owned by the creditors, and the company may be insolvent. Very, extremely dangerous position to be in. And this is why, as I mentioned before, it's very important that you do not over leverage your company and starve it from its ability to grow. So let's dig into this. This is going to get a little in depth with current ratios, or ratios that are used to help the strength of your company. This will be an exercise that you'll kind of want to do for your company. And we can go through this. And as I go through this, I encourage you to either take those or just go back and rewatch this video and do this exercise for your own business. So current ratio is assets with divided by current liabilities. So measure, let's go over to the right, measure liquidity. It shows a company's ability to meet its short-term obligations. An example of a current ratio is of 2-to-1, means that for every $1 of a current liability, the company has $2 in current assets with which to pay them. So you just do that ratio, you take your current assets and you take your current liabilities and you divide it. Which one is higher, first of all, and then you divide it and you can find out what your ratio is for your company. And the debt to tangible net worth, total liabilities, total assets minus liabilities minus intangibles assets. The lower in this case is going to be the better. So let's look at the measurement over on the right-hand side. Measures solvency and financial risk. This helps reflect a company's ability to meet its long-term obligations. You take your debt to tangible net worth, and the ratio of 2-to-1. That means that for $1 of total net worth, in order to have invested, the company owes $2 to the creditor. So 4-to-1 is considered as a high, depending on the industry. And in most cases, that is the case. So I encourage y'all to do that exercise there, and it'll be a good health check for you in your business. So here's our income statement. This is going to be over a period of time. Typically is either monthly, quarterly, or yearly. Sometimes people will like, and what we require right now as a bank, with the economic times that we're in, we'll do a statement from 2019, from January to September of 2019, and do a comparison, income statement comparison to year-to-date, January to September of 2020. The reason why we're doing this is kind of seeing what are some attributes in the company, where the struggles are, is the company able to maintain revenue coming in to the company? And what have you done to adjust that? What is it that is, most companies have to make some major adjustments within their company. And this is going to paint a picture for us to understand where you are at and what adjustments have been made. And are you receiving enough income coming in to maintain a net income, or at least have a healthy enough net income to sustain what credit you are trying to apply for and maintain what you currently have on your books at this time. So let's begin. Accounting equation of your income statement: revenues minus cost of goods sold and minus expenses equal your net profit or loss, hopefully not loss. The income statement reflects the operational revenues and expenses and business entity over a period of time. Many businesses have a fiscal year in line with a normal calendar year of December 31st. Basic format of income statement: you have your gross sales, net sales, gross profit, which is simply just your gross sales and less the cost of goods sold. And then switches to your gross profit, and then less operating expenses, general and administrative expenses, depreciation, amortization, interest expense, and then less non-operating expenses, your disposable assets, income taxes, and equals to net profit. Cost of goods represent all costs directly associated with the product or service being sold. Typically includes materials needed to build a product. Operating expenses related to business operations that aren't tied directly to cost of goods. Total operating expenses are deducted from the gross profit to determine a company's operating profit. And then you have your typical expenses: selling expenses, general administrative expenses, other operating expenses. We talked about this a little bit earlier. Depreciation expense. These are non-cash expenses that are subtracted that we will add back when we do a cash flow within the company. And so your tax credit given to the business for wearing out of its intangible assets, equipment or machinery, real estate. Amortization expense, similar to depreciation, however tied to capital expenses for intangible assets such as patents, non-compete agreement, etc. for a period of time. Net income figure is also referred to as the bottom line. At the end of the day, what is left over to be able to have as a profit and be able to use as your debt service or your monthly and calculated as your annual payments if you're looking at tax return. Net income, net loss expressed as a percent of sales is called the net profit margin. And then net profits are net losses representing an increase or decrease in an owner's equity produced by operating activity for the company. Remember, the income statement reflects the flow of revenues and related expenses during a specific period of time. Revenue minus expenses equals net worth, net profit. Cash flow. This is going to be going into the cash flow piece. This is a very important exercise I highly encourage. We've gone over your balance sheet. We've gone over your income statement or your profit and loss, also known as. And now this is the cash flow. This is taking everything we just went through and how do you put it into a calculation to understand the health and strength of your company. So let's dig in. Understanding cash flow. Borrower's cash flow is a primary source of repayment for every business loan. Cash flow analysis focuses on the cash that is generated through operating activities. Cash flow analysis is how the bank analyzes the borrower's ability to cover its debt service, which is simply debt service is going to be what are your payments? What is the required payment that you make on an obligation that you've exercised? Historical cash flow is reviewed for trends and to support future repayment ability based on the past performance. So typically it's 2 years. Sometimes, though, if it's a larger loan, they'll look at 3 years. when it comes to evaluations, and kind of see what is the trend. I encourage you to do that exercise for your company as well. Identify the borrowing need, evaluate primary repayment sources, and assist in credit structuring. Understanding net profit versus cash flow. Net profit indicates what a company has earned or lost in a given period of time, and is calculated by subtracting the total expenses from the total revenues and sales. Cash flow represents the actual cash available to repay debts, and is calculated by subtracting total cash outflows from the total cash inflows. As most banks are, BankUnited is a cash flow lender, and therefore it is very important to understand cash flows of your borrower, your small business. The beginning point for any cash flow analysis is the net income per books, also known as EBITDA. Net income per books represents the profit or loss after the business has paid its expenses. However, this is and may represent an actual cash flow available to service its debt. There are certain expenses and items that need to be added back to net income to arrive at what is called EBITDA. This is an essential to surplus cash a company has available to service its obligations in given year. EBITDA is the earnings before interest, taxes, and depreciation and amortization. Reiterate on EBITDA is definitely a calculation that is used, especially when you're looking to sell your company. It is one calculation that is definitely used, but this is what most lenders will use when it comes to understanding the availability of what's left over for the cash. So let's break it down in the calculation real quick. Simple cash flow. So your net income or loss, in this case is sample 1 is 150,000. Sample 2 is a negative 25,000 plus interest expense. So on your tax return, it's the very first top line, first page. Actually, now tax return is a little different now. It's the second page. But what is your interest expense? Just take that number and plug it in, and then plus depreciation, and you'll take that number and add that to this calculation, and then amortization expense, less shareholder distributions. So you will have in distributions that are taken out of the company for, as we discussed earlier. And then you take your EBITDA cash flow for debt service. So in this case is sample 1 is 160,000, and in case 2 is 35,000. So then what you want to do in this case, this will be a yearly number for your company. So you want to take all your debt payments and times it by 12. If you have monthly payments, take it times 12, and you'll understand what the debt service is. Digging a little bit of interest expense, not take too much time on this. It's simply what you are paying in interest for loans. Depreciation, amortization, we already kind of talked about this. Our non-cash expenses reflected in the income statement. Depreciation is accounting for depreciating assets and value. We've gone over this. Shareholder distributions. Distributions represent cash payment to the business owners after net income. So a lot of distributions are taken from the company into the personal, and shareholder distributions are not included in expenses. They are deducted from the net worth equity section on the balance sheet. This is what reduces your retained earnings when you pull money out through distributions. Since distributions represent actual cash outlays, they're deducted from or within a business cash flow and calculated and added to the owner's personal cash flow if the individual is an obligor to the loan. Amount of distributions are found on K1's schedules of the business tax return. They also be determined by reviewing the balance sheet of the business with the equity position. So again, we went, in this case, what we're doing is the same calculations, except for less shareholder distributions. We see here where it's taking $75,000 out, so we reduce it down to $135,000. Your debt service on existing loans, is your total payments for a yearly basis is 48,000, and the other side is 24,000. And then your debt service new request. What is the new loan that you're applying for? Whether it be a line of credit or a term loan. In this case, in sample one is 60,000. The other one is 12,000. So your total debt service is 108,000. When you add the debt service for the existing, and then your new request is 108,000. And the total traditional debt service ratio, you just simply take that cash flow available for debt service debt divided by the 108,000, so 135,000 divided by your 108,000, and you get 1.25. 1.25 in most banks across the board is a typical minimum that is required for approval. So if you do this calculation, you can kind of see where your company is, and you do that calculation, you can understand, figure out where you're at. At 1.25 is the bare minimum. Anything 1.24 will not qualify. So it's important that you stay above that. The higher it is, the better it is. Personal guarantors cash flow. This is important that where you're not personally getting into a lot of debt as well, because we will look at your personal side of your cash flow along with your business. Both are put together and calculated together when we look at it. So samples of a personal cash flow is your wages, interest, dividends, rental income, and plus your depreciations. So property income, if you have another side business that you have received income from, your shareholder distributions, the money that you took from the business and brought over to the personal, you'll be adding to the personal side, and cash flow before personal expenses, and then less your taxes and living expenses, which is calculated. All right, so sample personal debt service, your net cash to service debt, 114,000, and your annual mortgage payments, HELOC, installment loans, credit cards, total debt service. So you want, again, the higher the numbers, the weaker it's going to make the loan approval for your lending ability. So be very cautious not to get over leveraged and create too much debt for yourself. BankUnited qualifies loans based on global debt, which simply means is we take your business cash flow, your debt service, and your personal side, and we combine them together. And what is the health and strength of the company and the individual that's guaranteeing the loan. So this is where it's adding to both the global debt service analysis together. Your business cash flow. This is company sample one that we used, 135,000. Personal cash flow is 114,000. So your global cash flow, you just add them together, is 249,000. Then you take your business debt, which is, remember, your annual number. Take your personal debt, your annual number as far as your payments, and then you combine the debt service, and you divide the numbers from your 249 for the 183 to 526. You get 1.36 as a debt service, which is a qualified number. Notice that the company was 1.25, and now we have a combined of 136, which the personal side helped this loan get qualified. There are times where the personal side will weigh it down and not be able to sustain, and actually will make the loan not qualify on. This is where you got to be very careful with partners. Who are you partnering with in your small business? Are they very heavily over leveraged? They can eventually potentially hurt the issue with lending. Anybody over 20% is required to be on lending as a borrower guarantee for lending. So I hope this was helpful. I hope this will be a better understanding of where your company is, where your small business is. And just want to open up with Stacy and Bill and see if there's any questions or anything we want to discuss further to wrap this up.
I have several questions. Some are directly related to the presentation, and then some are more general bank/lending questions. So we'll go with the presentation questions first, and then if we have any time left over for the more general lending type of questions, we'll maybe try to tackle some of those. So Dennis, one of the things that I see a lot is when people come to me and they're looking for financing, they confuse business credit and personal credit, and a lot of times they tend to think that, hey, I'm a relatively new business and I'm going to get this loan. It's a business loan, and and my personal credit isn't going to have anything to do with it. I think with the presentation, you've kind of touched on that, but I wondered if you could expand on that a little bit. What business credit, how difficult it is to kind of establish a business credit rating, and where that really comes into play versus a more traditional business loan where there's the personal guarantees and the person is actually backing that loan.
Yeah, so absolutely. So when it comes to lending with banks for a small business loan, it is almost in an extremely rare situation that you're going to find that the bank is not going to require a credit report on the personal side. Similar to a lot of banks don't even look at business credit sometimes. You're starting to see a little bit more of that to occur now within the industry. But on the personal side, it is absolutely 100% crucial that your personal credit is protected, and not to, especially one of the biggest things that hurt personal credit is credit cards. You have high credit limits will have a major impact of your score. I've taught a lot of these classes, and when it comes to understanding the breakdown of your credit limits and where does this number get. So 30%, anything below 30% is a good mark. Anything below 10% is a better mark as far as improving and helping your score. And then it goes down to 6, and then obviously 0, just paying your credit card off. Once you get your statement in the mail, pay that balance off, and you won't have any interest owed. Just paying it off on a monthly basis is very important. It will help your score significantly. But if you're in credit score, your credit limits are very high. Anything, especially past 50%, you're damaging your score versus helping it.
So, just for clarification, what you're talking about on that percentage is percentage of usage of their total available credit for credit card. Okay, very good. Thank you. So you also touched on the 5 C's of credit early on in your presentation, and I wonder if, from your perspective, as you're with your long history in business banking, what you see of the 5, what is the one, if there is one C, where the folks that come to you, the potential borrowers, are lacking the most of those 5? Is there one that kind of stands out more often than not, that it's like they really struggle with meeting the thresholds that the bank might have in place?
It's a good segue to what our last conversation was when it comes to personal credit. This is the one thing that we see the most as far as that will turn down a loan. There's other things when it comes to the cash flow, obviously, but that's the very first thing that we look at. And we try to uncover those opportunities in the forefront. And any good banker will discuss that with you and talk to you through that before the application, kind of get a snapshot of where you're at. So character is very important to most banks, but they're all important. So
just to follow up on that, so a lot of times people focus strictly on that credit score, and they don't look at everything else that's in the credit report. How much emphasis does the bank typically put on a score, like, I got to have a 675 or above, or whatever the number is, as opposed to the overall picture of what might be contained in that credit report?
So there's different types of lending, and a lot of it has to do with the lending amount that you're looking at. What is it that you're applying for? So, for example, we have we call it a pronto loan. It's a very small loan up to $250,000. It's primarily just focused on your credit score.
I know that generally the banks will look for 100% collateralization of the loan, and I know that there are a lot of the loans, term loans these days, are maybe being done through SBA guarantees. Are there situations where the bank I'll say at the recommendation of the SBA, would consider a less than 100% collateralized loan?
Yes, absolutely. So like for example, if you're looking to purchase a piece of equipment, typically we'll go up to 80% of the value of that facility, whatever that piece of equipment is. And like for instance, also, so typically it's 80%, whether it be real estate or will be a piece of equipment or something that's being purchased. When it comes to lines of credit, we iterated earlier as far as the up to 90% of your accounts receivable, and then we'll subtract, obviously it's only up to 90 days, and then 80% of that number, okay? So, and then we'll look at your inventory as well, and typically do up to 50% of your inventory calculation.
All right. Very good. Okay, I wanted to ask you then, I know you spent a good portion of your presentation time on the balance sheet, more on the balance sheet than the other two components. And I'm just wondering whether in your experience as a banker, was that done because you see when the typical small business owner comes to you, that's the area they have the least knowledge in, that they, generally maybe they understand the P&L, but the balance sheet they don't really understand at all?
Yeah, the balance sheet is one that's been, a lot of people understand, most people understand the balance, the profit and loss portion of it, money in, money out, and what's left over. The balance sheet is one that is a snapshot of your company and the health and strength of your company. And it really paints that picture of, are you over leveraged, or do you have that ability to be able to have that lending ability and strength? So are you over leveraged or under leveraged when it comes to it? So balance sheets is very, very important. Yeah, that was why I spent a little more time with that, because it's one of the most missed pieces of that pie. Not that the profit and loss and your debt service is important, but that's what puts things together, and understand where does this company have the liquidity or capability to be able to stay alive in situations like we just had, and does it have that strength? And if you don't understand your balance sheet or know where your balance sheet is, then you don't have that capability of knowing where your company will survive or not.
Okay, very good. So from a bank's perspective, how often would you as a banker like to see a small business owner reviewing their financial statements, the balance sheet and the profit and loss, and obviously looking at cash flow as well? How often would you like to see them doing that?
I would say at least a quarterly basis, at the very least. Anything past that, you're getting too far stretched out to understand even potential seasonal aspects that the company may have. And so definitely, I would say a minimum of quarterly. Obviously, the more you do it, the better. So monthly is good, but I would definitely say quarterly is most important.
Okay. And then does the bank ever request, when they've loaned money to a small business, do they ever request a review of the financial statements for that business?
So our lending, when it comes to BankUnited, is anything above $1 million. We could do a annual review of financials, but anything below that we do not, unless we see there's sporadic spot soft checks of credit, and we see a major de-escalation of credit score on the personal side. Again, remember, personal is important. We will look to see that, and we will then, at that time, we have the right to be able to review financials, to kind of see where the company's at and see what's going on.
Okay, very good. So in terms of the, you touched on a couple of different ratios, and I'm just wondering, for example, on the current ratio, is there kind of a benchmark for BankUnited where say, hey, we really want to see this be at least 1-to-1, 2-to-1, 2.5 to 1. You guys, do you evaluate the balance sheet in that perspective and say, hey, if we're looking at lending, we really kind of want to see a 2 to 1 in that area?
Yeah, so this is something that we look at. It's typically a 2 to 1 or greater, and anything below that is we're going to start really digging deeper into it. Again, we don't look at this ratio unless it's larger loans. Typically, 250, 350 and above that we look at with lending. So your smaller loans, we don't typically look at the ratios. But
okay.
Yep.
All right, very good. And so, touching on, because you on the cash flow, and you talked about debt service of 1.25 is kind of like the line in the sand, has to be at least that. And then you brought in the global cash flow. And when it comes to that, just for clarification for somebody who's looking to get a loan, when you add in the personal, you're adding in all aspects of family income and debt, right? Not just say it's Mrs. Smith or Mr. Smith that's the business owner is getting a loan, but Mrs. Smith might have an outside job that also brings in income. For that global picture, you're looking at the entire family's ability to cover that debt, right? Not just Mr. Smith.
So we will look at, what we look at is when it comes to personal global cash flow, the individual that is going to be the borrower guarantee on the loan is the only individual that we would look at. So let me give you an example. Is husband and wife has a situation where the wife owns the business and the husband is outside working on another job. And the husband is not going to be on the loan, okay? We would not look at his income. His income is not able to be a substantiation for the global cash flow, okay? We would look at just her when it comes to lending ability, when it comes to lending. So sometimes that can create some issues with, she has all the debt on her name and not on his, or vice versa, So there's some parameters that we do look into when it comes to those kind of things. But if the spouse is not on the loan, we will not look at their income. Okay.
All righty. That's good to know. You touched on this a little bit, and I just wondered if you would maybe elaborate on it, is matching the type of debt to the type of asset that it's being, short-term debt used for short-term assets, could you, because I see that as a lot of times a problem for borrowers where they've gotten themselves into trouble by using short-term debt to try to finance long-term assets. Do you guys see that at the bank, and would you maybe expand on the importance of that a little bit?
We do see this, unfortunately, a lot. This is where those lines of credit are being abused to the wrong purpose, the wrong structure when it comes to lending. The situation is lending is not the all-end-all to success to a company. In fact, it can be the opposite, especially if the behavior is not there to be able to properly use that facility and what you're looking to do. So lines of credit are the biggest ones that are misused and not used for the right purpose. So a lot of times we'll see that where somebody will take a line of credit and they'll use that to purchase equipment, and it's just not the right avenue, because the lines of credit is so important to be able to help with your next future project that you have for your company, to be able to facilitate what that product is. And there's a lot of times, and I've had a lot of numbers, especially in the manufacturing side, I've seen in my career that, there's one particular company I see, I'm thinking about right now, was substantially successful, and because they were able to properly utilize that line of credit. If they didn't do that, they would not have been able to accomplish some very major projects that they had in the future that they didn't know about at the time, but they knew what the proper use of that line of credit was for. And when they used it correctly, they had the assets to be able to line, be able to utilize, to be able to buy the materials. It was a very time-sensitive situation, which landed them a very large and a monumental opportunity for their company in the future, and sent them to a whole new level of opportunity. And that's because they were being diligent with that short-term use of funds, and allow them to be successful.
Okay, very good. All right, if you don't mind, I'd like to ask you a couple of more just general lending type questions, and I don't want to put you on the spot, so if if any of these you don't want to answer, that's okay. In general, it appears that right now the banks are being very conservative in lending to small businesses in light of what's going on. Is that an accurate assessment? And if so, when do you see that starting to turn around to where, it seems as though prior to COVID, the lending situation for small businesses was pretty good. And now it's a struggle. So is that accurate, and when do you see that potentially turning around?
So what I'll say to that, and I obviously can only speak toward where BankUnited is at in our position, and I'm pretty sure I'm speaking correctly with this, and what I see is we're not pulling back lending, but we are being more cautious. We're doing a little more deep dive into the small business to understand where that company is and what have they done. The biggest thing that what we do is we compare, like I said earlier, is compare the income and balance sheet from previous year. So we'll take January to September 2019, and we'll take January to September of 2020, and we'll do a comparison with side-by-side comparison and look at those numbers and see what story is being told, and is the revenues somewhat on equal basis? Where is the net income on it? Are there more expenses being spent somewhere else for some particular reason? And it might be the case because they might have to revamp some things, which is fine. But where is the company lendable based on the trend that it is on currently of 2020? And obviously there is that hiccup that we had March, April. Like for instance, a lot of manufacturers have a situation where people that make products or even service companies, they had a supply chain issue with in the very beginning. March, April, practically nothing was getting delivered, so it backed up a lot of manufacturers from being able to produce products. So a lot of them, you're starting to see a lot of catch-up being played now at this point. So what I'll say to that is this: BankUnited is lending. We are lending, and in fact, we're hitting some very interesting numbers right now in our lending as far as the bankers and things like that. Because there are a lot of companies, and this is what I'll say to this and kind of segue to this. I'm glad you brought this up. Is small business this right now in this era that we're in, this month, October 21st, right now, is an absolute crucial time for a small business owner to take advantage of. Because what's happening is you take your small business owner that has a certain segue in a certain industry that they're in, and you have John Smith over here that has the same exact business that you're having, but they're not digging deep in and working hard right now and being able to take off all that business that's out there. There's a lot of business out there to be taken, and because there's a lot of businesses that are failing, unfortunately. It's sad, but it is the situation. There's companies that were struggling prior to this COVID situation and are now really struggling. So if you're able to maximize on this opportunity, I can pretty much be very confident to say 2021 is going to look very good for you. But it is crucial that the small business owners dig deep right now and find that niche that can make their company very, very successful. This is a restaurant company that is one of my clients, and March, it was a very, had some very had to pretty much be the listener for him because he was very, very concerned, obviously, as many of you in the small business sector was. And he didn't know what he was going to do. So I really was just trying to provide that consultative consultative advice to him. Just told him, hang tight, let's revamp some things, look for some new opportunities. He did, and so a month later, he was like, okay, it might be like a 30% loss. Now he's hitting numbers well exceeding what he did in 2019. Why is that? It's because he was able to rethink about ingenuity of what he was able to do, and revamped how he did marketing, revamped how he got the word out with everybody, and now he's going to hit record numbers than he ever has hit in his company's history. He's a restaurant. We all know what's happened to the restaurant industry. So it's all about that ingenuity and being able to think outside the box right now. It's very, very important time.
Well, I'm glad that you mentioned that. I'm glad that you specifically mentioned restaurant as a example there, because one of my questions was going to be, are there any industries that BankUnited is kind of shying away from right now? And I would, just based on what you see, you'd say, hey, probably hospitality, restaurants and bars might be one of those that BankUnited and probably the lenders in general might be shying away from. But you're saying certainly that's not necessarily the case with BankUnited in that particular industry. Are there any industries that you guys are really, or is it more just a case by case?
So it is case by case, really digging into the financials, but hospitality is one of them. We are not lending to. Restaurants is one that we have to play a very, very, very close eye to. The biggest current fear right now, concern that the banks have right now is this going to happen again? Is this virus going to come back or revamp itself and come back out to a situation? We hope that it doesn't, right? But that's the concern, is things going to get shut down again? And that is a concern in the situation that banks are paying a very, very close eye on right now. So that's why that evaluation that we're doing and we're looking at when it comes to the financials is how did they survive the current situation that happened in March, right? With COVID, and then will the company be able to survive another wave of something happening again? And so that's kind of what we're looking at and paying a close eye on when it comes to that. But so absolutely.
Okay, just a couple more questions. Are most of the loans that are being done right now for BankUnited, are they mostly SBA guaranteed loans? Does that seem to be just because of risk mitigation maybe on the bank's part? Is that what most of your activity is?
Actually, no. Most of our activity is actually is on the conventional side. We do the SBA. We're an SBA lender. We have a national group that's in the SBA field, and we do a lot of SBA lending. 504s, the rates on 504 for real estate is insanely low right now. We're in the twos for a 25-year fixed guarantee.
Yeah.
We're not going to, if anybody, small businesses, has the capability or is looking to do something, that's up to 90%. Value that you can lend up to. So 504s are becoming very popular. The closing costs a little bit more, but when you're looking at the availabilities of that lending rate that you're looking at are just absolutely, completely unheard of. And so time to take advantage of it if that company is in that position to be able to do so.
Yeah. All right. So that's interesting because I would have thought the opposite, that maybe the SBA would be more heavily weighted towards SBA. So just kind of quickly for the folks that would be listening to this, major difference between the two in terms of equity that you're going to be looking for versus an SBA loan, maybe if there's much of a difference in the rate and any other. Probably quicker to close with a loan done directly with BankUnited as opposed to going the SBA route. But anything you would highlight as differences between the SBA guarantee and being able to get the loan directly from BankUnited without the SBA's participation?
Well, when it comes to SBA, obviously we're going to have that guarantee, so the bank's going to be a little bit more protected. So it's going to be a little more enticing for us. When it comes to lending with SBA side, we can go up to 100% on lending for a lot of things, for equipment, things like that. But we can also go up to 90% on real estate. Which is sometimes can be a game changer for a small business owner that doesn't have the full capital to be able to put down for lending it. And in our 504 SBA loans, I mean, you know, 2% too. I don't know. I want to quote rates right here, but I know they're in the twos.
Yeah,
they're phenomenally low right now, and so great position to be on. But we'll say that conventionally we are lending, and we're also on the SBA side, and SBA is going to be obviously a little better protection for the bank.
Okay, thank you. Just one last question. When it comes to business plans, does BankUnited still require business plans from their borrowers, or is there a certain level of loan at which you require a business plan? I know with the SBA, obviously you have to have them, but what's BankUnited's internal position on business plans to support a loan application?
So as far as requirements for our lending, business plans on the conventional side are not a requirement. But I would tell you that it is definitely good to know that you understand your company and that you've spent the time to understand your company and understand what your vision is and what your focus is. On SBA, yes, it does require that. But when it comes to business plans for the conventional side, it's not a requirement. We will dig deep into understand your company significantly, and these business plans will help us do that, have a better understanding of your company. So those are very important to do, but as far as a requirement, it's not a requirement. The banker itself at BankUnited will do what they call a credit memo, which is a full, pretty intense background of understanding the company, and that's just coming through asking questions and things like that. But if we have the business plan, that's going to help the underwriter understand the company in a better facet and better avenue.
Okay, so not required, but highly desired probably would be the answer. All right. And then still you are going to require them to have a couple of years, at least a couple of years of projections on the P&L and cash flow to support the loan application, regardless of whether they supply you a full business plan.
So when it comes to projections, on the conventional side, we always look at what have you done, not what you're going to do for us. Those are always definitely good to have, so we can kind of get a snapshot of what we're looking at. But when it comes to banking and when it comes to lending, we're always what have you done so far versus what you're going to do in the future. On the conventional side, obviously on the SBA side, it is a requirement. And then as far as requirements, again, up to 250,000, we're going to have practically it's just credit score driven practically.
Very good. All right, well, I think that's all the questions I have. I appreciate you taking the time to answer those. I know there's quite a few questions there, but those are some of the things that I know that the folks that come and see us and the types of questions they have when it comes to banking and lending and so forth. So I appreciate taking the time to answer all those.
So